Yeah, absolutely. Gosh. Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It is Thursday, June the 1st. We're heading towards the end of the second quarter. I'm delighted today to be joined by Richard Radolia, CEO of Matrix Global Holdings, Matt Stanley, Partnerships Lead for the Middle East at Kipler, and for the first time, a special welcome to Paul Horsnell, Head of Commodities Research at Standard Chartered Bank. Thanks, everybody, for joining us.
Thank you.
Matt, let me start with you. Let's talk a bit about sort of immediate technicals, I suppose, and prices on the markets. We have a couple of headlines there on our bulletin saying oil is dropping, prices are dropping on inventory bills. And then we also have a headline there saying OPEC may output. We finally have evidence of the cuts that OPEC's brought in. But Matt, how much impact have the cuts or the announcement of cuts so far by OPEC this year had to support prices? Not much by the looks of it.
Yeah, morning, Diala. Morning, everyone. That's a good question. Flat price Brent is down about 10% so far this year. How much further could it have dropped if OPEC hadn't have intervened, and surprised the market in whatever it was in March or something? Look, it's market perception, and what the group have done since the introduction of OPEC Plus is that the market has a lot of confidence in the group and what they do and how they do it. I'm not sure the narrative about people ouching any short sellers, but it's, essentially the group is there to keep prices stable, look at the supply and demand balance. So anyone short selling a market that relies on oil income is obviously going to be greeted with that kind of aggressive narrative. But how much further could prices drop? Look, I think the discussion that the group are going to have over the weekend will be amended somewhat from what they perceived it would be this time last week. Brent has had a bit of a brutal week so far. China data continues to disappoint, so the group will look at that. But this week, it's been a risk off because of the debt ceiling issue in the States. But yeah, look, there could be a bit of a relief rally once that is finally stamped by Congress. But yeah, the group this week, it's a different conversation they would have had a week ago, like I said. But yeah, we'll have to wait and see what they do.
Okay, Richard, just go to you on just sticking to the OPEC theme. And yeah, we have now the debt ceiling deal pretty much done and dusted. We had a survey question yesterday which showed that our audience was 50-50 on whether that would be positive or negative for oil, energy, demand, prices. So that's kind of been absorbed, I suppose you could argue. But would you agree with Matt that the picture that has changed for OPEC in terms of what decision it might make this weekend?
Yeah, kind of a couple of things to unpack. Yes, I think having a market fall, 7-8%, right in the face of comments made by OPEC talking about possible cuts and hurting the short seller, I think is obviously something that's to be concerned about. But the market remains in a trading range, right? It's like if you look at Brent at $68 to $90, it's been that way now for multiple months. I think demand from China continues to lag, and we're kind of seeing that, and so there's this disappointment. But I think there's a longer game being played here. And I think the longer game is OPEC Plus, it is Saudi Arabia, it is MBS and his minister talking about how are they going to deal with this transition. And I've said this continually, and I'll say it again. I don't think the issue is now. The market's going to be in a band here. We're going to see demand. If it picks up a little bit, we'll tick a little higher. But if it doesn't, the market can make some moves to the downside. But the long game is really one of, what do you do to manage the supply of oil in a world where the supply-demand balances are known almost instantaneously? If you know where demand is, you can adjust supply, and that is different than what we've ever experienced, in at least my experience in OPEC, going back really from the last 3 or 4 years. Before that, it was always this unknown. And I think what OPEC is doing, and it's telling people this, that we are going to adjust supply to maintain a price that we think is relevant for us. Fortunately for Saudi, they have a high number to start from. I think that we'll have to think back to what Russia is going to do, because I think what Russia is doing is very important. They were, if we all remember, in March of 20, Saudis open the floodgates and punish the oil market. I don't think they're going to do that again. So I think there's a number of things going on here, both from a supply-demand balance and OPEC saying we're going to try to balance it. But I also think we can talk about it later. I think there's a lot of geopolitical stuff that's going on that I think might go to a change of the policy that we're seeing.
Okay, thanks. Paul, welcome again to the program. Great to have you with us. You're based in the UK. Let's have a more sort of macro view from you of the decisions that OPEC is taking and central banks are taking at the moment in terms of the outlook for economies and how that's impacting commodities outlooks and prices. We had people on the program yesterday who were kind of saying, a banker actually, who said that actually the opposite has happened to what was expected this year, and that the second half of the year is actually going to be now possibly weaker macroeconomically than the first half was, with everything that's being done feeding into fundamentals on the ground. So from a commodities sort of demand point of view, give us your outlook for the second half of the year.
Yeah, I think again that feeds into OPEC's decision this weekend. I mean, I think if we sort of roll back and do it in the old-fashioned way, so just do a supply and demand balance and projections, just as if it's been done almost since time immemorial, then you'd start from a position that OPEC's producing probably about 28 million barrels a day, roughly, would have been the May average. The call on OPEC for the second half of the year, we think it's 29.5, so 1.5 million higher than that. The IEA's got an extra million on top of that. They've got roughly 30.5 for the second half of the year. And in different emphasis in both cases, not a particularly upbeat macroeconomic outlook behind that. In our balances, OECD demand falls this year, US demand falls. All of the work has been done outside non-OECD. So if you just take it on that old-fashioned way, this meeting's absolutely easy. You're really talking about when you're going to add oil rather than anything else. Again, that's the old-fashioned way. I said it's old-fashioned, that's not how markets work anymore. But just to start there isn't a fundamental problem here. We could be a long way out. I'd be $1.5 million off with that call on OPEC, which that would be quite a crash, and still wouldn't be getting a build in inventories. So overall, one option for OPEC is patience. Believe in the numbers, they will come back to them, continue the inventory draws that have started over the course of the past few months, and just let the market work its way out. Now, I perhaps disagree that we always know where supply and demand are. I think the lesson of the last year is people don't know where supply and demand are. They thought there was a deficit in the second half of last year. There wasn't. There was a huge, great surplus. There was one in October. There was a surplus at some note in April. So fundamentally, it's not an issue. Where it is an issue is again how markets work. They are embedding a much more pessimistic view. They're reacting over and over again to the same news. So a $5 fall this week on one China PMI reading. I mean, don't have to think about that too much. See, that's a bit silly. That's far too much weight for one poor reading. Might get a good reading next month. There are other versions which are better. It's just all a little bit overblown and dominated by that sort of macro concern. So if OPEC reacts to that, then I think there is much more of a case of a cut, or at least a tidying up, to bring in some of the voluntary cuts within inside the formal mechanism, just tidy up some of the targets from where they were before. And I think that's the discussion. Which fundamentals do you react to? The ones that seem to be there in the numbers, the ones that have come through this year, demand is surprise to the upside this year, even though the markets believe demand is surprising to the downside. Just one last data point, and that obviously US data yesterday. US demand for March revised up 400,000 barrels a day from the weekly balances, from those implied by the weekly balances. So again, part of that contention, fundamentals are not bad, demand is not deteriorating, it's actually improving, but the dynamic and what's being traded, I think it's the other way around. We're on the edge of a precipice, and this is 2008 again, or whatever.
Yeah.
I think we disagree.
Okay, so fundamentals aren't so bad. But Matt, yesterday, one of our speakers was saying that, for example, US gasoline demand, driving season now are meant to be at the peak, has really disappointed forecasts. It's actually contracted rather than increased 6% or something. Correct me if I'm wrong on the figures. So where is that evidence on demand for the US economy? And also give us a picture on shipping and how that's reflecting what demand we're seeing for various products.
Oh, that old skeptic Russ Edwards, was it? Yeah, no, look, it's fine. I argue with him on Monday about the very same. Look, it depends in which. I totally agree with Paul, and welcome, Paul. It's spot on. It's how the market perceives fundamentals is the issue. That's the problem. Where are people where is risk on coming from? Is it coming from the funds? Are they looking at things from a more macro point of view, or are people concentrating on more the physical fundamentals? This is always the argument when it comes to analyzing with the direction of flat price. But we still have gasoline demand down in the States by about 1.6% lower than pre-pandemic. And I hate this term pre-pandemic, but it is that data point that people are still looking at. And jet fuel demand, we still have lower than pre-pandemic. It's much better than it was 2 years ago, a year ago. China has continued to disappoint this year. I agree with Paul that we can't look at one data set. Does it carry the weight of a $5 drop on Brent? No, I totally agree with him. It does not. It has to be a culmination of things. But market sentiment has and always seems to be complacent on Chinese growth. If that disappoints, we see a reaction in economic sentiment, globally, seemingly. Shipping, again, what we're seeing is trade patterns changing all the time. We've seen a new. It's a fairly minor in the drop in the scheme of things, but the Azores seems to be a new ship-to-ship location for Russian energy. It's not necessarily the quantity of what's happening. It's just symbolic of that the whole circus is moving from one position to the next, and it will continue to do so. That is weighing on freight because the market is becoming more and more fractured, i.e. the dark fleet and the fleet under the price cap, etc. We could see that continuing, but it's tough. Gasoline needs a good driving season. It started on Monday with Memorial Day. Initial data looks good. It needs peril and humanitarian issues aside. The market is also hoping for a busy hurricane season because that's always the arb from gasoline, because the refineries are shut in the Gulf Coast with the busy hurricane season. Gasoline moves from Europe. All that gasoline that's used to go into West Africa, with the Russians are now supplying. So it's all a linked story, Diala, to be honest. But ultimately, freight is still elevated and it's becoming more and more fractured.
Okay, Richard, give us your take today at the beginning of June on the US economy, sentiment there on the ground. We talked about gasoline now, but just generally speaking, in the context of the debt ceiling deal that's just been done, the banking crisis that has passed, perhaps some would argue, what's the sort of outlook for confidence in consumer spending going forward?
Good question. I think the U.S. economy is just okay. Inflation still exists. I continually hear from people how things are so expensive, and so while the economy is okay, I don't think we're not going to some recession right now. There is a kind of a sense of there's a malaise in a way. There's a sense that things aren't going that great. Our political system is not on the up and up. We're kind of going into the election seasons here, and we have two people who who are the head of both parties that no one really wants to see in power. So economically wise, we're okay. I don't think there's any issues. I think demand is flat. OECD demand in the world is flat, full stop. I mean, we don't look for the U.S. or anywhere else to have a huge uptick in demand. I mean, I think where the U.S. is looking for is we did pass a deal that gives a little more solace to some of the energy producers and the ability to export some more barrels. So I think that's a positive as far as getting barrels into the marketplace. But in general, the U.S. is okay. I don't think it's an issue. I do think an issue that, and this is maybe I'll be the first one to say this, and I don't. You can agree or not agree with it, but I think we've been into this bifurcated world. And I think where the U.S. is suffering is by its relationships with the counterparties and with the OPEC world. How woke is the IEA, the EIA, the DOE. You know, these are woke now. They're pushing not only the energy transition, they're producing everything else. And if I'm a country that produces 10 million barrels a day based on a Wahhabi tradition, I wonder how that I feel about that. I'm being told you don't want my oil in 10 years. You're telling me your way of life is better than mine. And so I wonder if we're really seeing this geopolitical shift that's more political than fundamental. And I don't know if that's right or not, but I get this feeling that we're trying to push our agenda across the world, and it's a weird agenda now, and it doesn't necessarily tie into the beliefs of the people that we're trying to negotiate with. And so I think what we're experiencing is just that. And I don't know how long it's going to last. You know, Russia is no one's friend, so let's not look at them. But the rest of OPEC Plus, I believe, is playing a very long game. It's out for long-term survival. It's a calculator. How much can I produce at what price, and how long can that last me? And I think those are the calculations that they go on through. Will go on now for the next 3 to 4 years.
Okay, well, let me just stay with you, Richard, on that. Russia's no one's friend, but OPEC leadership has pretty friendly with Russia. A, they're in the group with them, agreeing on policy, and B, in the Europe war, they're not exactly opposing it. But how long can that? A lot of people in the last week or two, as prices continue to be under pressure, Russia's not doing its fair share of cuts. Is that relationship at all within OPEC Plus, do you think, vulnerable going forward?
Well, I think it is.
Right.
But remember, in fact, the last time I was on, I had that chart of the last 6 times that the oil prices collapsed, and it was always based on Saudi Arabia: 86, 92, 08, 14, 16. These were all major shifts by Saudi and the UAE. And I think they're wise enough to realize they cannot get into another war with Russia. They both saw what happened in March of 2020, followed soon after by COVID. I think there's going to be a lot of leeway. I don't think that they're friends with them. They are their cartel friends with them that maintains a higher price for oil that allows them to spend the money they need on their budgets, that they can extend that money as long as possible. As I've said this before, I was wrong on peak supply, which was a concept that was back in the 80s and 90s. I'm not going to be caught on peak demand. I don't know when demand's going to peak, but I'm not going to pick a point in time. And to me, peak demand, if you get to 110 million barrels by 2035, that's a whole different world of who's going to be supplying that oil. Because Saudi Arabia has said in one of the most important meetings in February, we will not balance the market forever. We are not going to balance it forever. And with the lack of investment going into the upstream sector due to the transition, I think that's the problem that exists out the curve.
Okay, thanks, Richard. Paul, back to you. Let's get a European sense from you. You're sitting in the UK, where we've had a few months ago, a serious cost of living crisis. Has that improved? Has sentiment improved on the streets in the UK? And just from a sort of commodities forward outlook of consumption, gas prices going forward, what's the sentiment in Europe there in terms of the next 6 months? And also just, I mean, I've throwing a lot of things at you, but to tie in the sort of central bank policy likelihood of following the US Fed or not, etc., as we go forward.
Yeah, no, I think energy probably has been a major driver of sentiment this year. The fact that prices are now considerably lower than they were before. We're dealing with Dutch TTF prices in the 20s, 20 euros per megawatt hour, has been 300. So a considerable sort of year-on-year reduction in the energy component of inflation. The other bits of inflation have proved a little bit more stubborn. I think, again, that feeds back into why oil is trading very heavy. There is this view that if you like Atlantic Basin, the US and Europe are on a hiking cycle that may continue for a little bit longer than was anticipated before, might reach higher terminal rates than before. We're with a generation of traders who actually had not traded through a rising rates cycle of this kind of magnitude and duration. And so it's a different thing to trade. And I think quite a lot of the magnified effects now on the oil price are, well, it's twofold. It's first very closely related to rates. It is exactly all of those concerns, and ECB is part of that, Fed is the other part of that. And the other part of it is that if you try to trade oil any other way over the course of this year, you've tended to be hit by some kind of steamroller. you could say that, as I said, that the fundamentals do look better. They demand prospects have improved over this year. The data's coming fine. But if you try trading that this year, you might be right for a while, but then the selling starts again, the trends, the algos kick in. We do then get back to this much more rates-driven view. And someone just said that that's the way the market is trading. That's what's driving it. It will change, but for the moment, I think your question is actually the key one, because that rate cycle is probably having a bigger impact for the moment than some of the more oil sector-specific factors.
Yeah, and there's of course speculation on how much longer that will go on in terms of more increases. Certainly they're staying, and people are now coming around to the fact that we're not going to see a reduction rate as we may have been expecting by the end of the year. Matt, just to go back to you a bit more, back to product, we touched on jet and gassy. What about diesel? Because that's been pretty dismal, hasn't it? Globally, more or less, although somebody made a comment of slightly positive figures, I think, for Asia. Turning around. What does that tell us, obviously, about manufacturing and where's the curve headed, if you like, on that?
Yeah, look, I just want to touch on something Paul was mentioning in the questions you were asking there, because he mentioned about the natural gas prices. I mean, it's the story about natural gas, I think I find it extraordinary that no one has written about it. Compared to where we were a year ago, cost of living crisis, the Daily Mail had a field day, everyone wrote about it, everyone was panicking. And people were moving from gas-fired power units to coal because it's cheaper. Now it's the other way around. People are moving from coal to gas because gas is that much cheaper. There was a Bloomberg article on Friday saying that gas could potentially turn negative in the end of summer. So what are we talking? Are we talking, an apocalyptic situation on the gas crisis, when all everyone was writing about last year was because of Vladimir, no one's going to have any gas, and we're all going to have to wear jumpers and knit our own long johns or whatever. So it's amazing how much of a news value that nat gas story is now, and I think it's an important point to make, because I don't see the crisis as over crisis, because once the winter buying season comes in, say October, when we start drawing down on elevated stocks, Europe's nearly at tank tops on gas storage. All of it needs to be replaced. Is the infrastructure there? I don't see it's the end of that story, but it's done a complete 360 in a matter of time. And onto your question, so have diesel refining margins. That's down to a number of things, and it's all related really to the energy crisis. Diesel had a spike because of natural gas, so there were secondary power generation fuels that were required, and diesel is the world's biggest industrial use fuel. Everyone wanted it. If you're driving a tractor, if you own a power station, it was there as a sort of backup feedstock. Not if you drive a tractor, that's what you need. But it's the story has waned in the same way as the nat gas one has. Plus, you've got, again, weak Chinese data that continues to come in, be weaker than people were hoping for, not necessarily weak. And then you've got the new refineries that are popping up everywhere, some in China and especially in the Middle East. Here is Rich, and I had this discussion when I saw him during IP week. I can't remember in the end what we spoke about, Rich, but when we started the conversation, it was certainly around refining margins and what's happening in terms of energy investment. And the people who are putting their hands in the pockets are the state oil companies in the Middle East. We've got the new one in Jizan, the Saudi Arabian one, it's reducing a lot of diesel. We've got the Dukhan one coming up in Oman at the end of the year, apparently. And then you've got what's happening with Ruwais. Bahrain are upgrading their refinery in Sitra. That's the plan. And then you've got the new Al Zour refinery. And all of that material that's moved, that was displaced from Europe, i.e. diesel, 49% of Europe's diesel came from Russia, is now being sourced from the Middle East and West Coast India. So it's just more barrels are available, supply and demand, obviously the balance is back. And it's meant that diesel refining margins are sort of in the mid-teens right now, as opposed to the $70 a barrel this time last year. So I see that story continuing, to be honest.
Massive difference. There's this question for today, just ahead of the meeting this weekend. Again, interesting, they've chosen, they'd previously booked that weekend on the June the 3rd, but they have now invited the press to this meeting in person. So OPEC are building up this meeting of what are they going to announce if nothing's going to change, apparently.
But sorry, Diola, have they invited the press?
Yes, they have, but maybe just some press.
Certain people in the press.
Yes,
Right.
yes. Some invitations went out 1 or 2 nights ago, I believe. Now they
But
may
no
revert-
Reuters, Bloomberg. They're
Yeah,
not invited.
I
I'm
think
not sure.
that's a couple of the big people to that point. If I may jump in,
They
if
haven't
I go
invited me.
I go back to the political nature of this. If someone is telling you, and I don't know what they said or did, if the Western press is saying something that is, energy transition at every breath. I mean, that's what they said at every, Bloomberg, they have everything is energy transition. I live in California, believe me. All I ever hear about is solar, wind, and electric cars, and on and on and on and on. I wonder if this is just more towards this. And again, I don't mean to get too political on this, but is this kind of another woke reaction? Look at Reuters, Bloomberg, Wall Street Journal. We don't like what you're saying. So guess what? You can't come.
Yeah.
And I saw in one of our text chains that people, they're not being statesmanlike. Well, they're not being called that they're a pariah either. So, when you call someone a pariah of a head of state, I don't know, that wouldn't sit well with me. So I just don't, I really think we need to, in my mind, after, doing this for a few years now, I kind of look at this long game we're in, and it just seems like things are changing. The political dialogue is changing radically. China did a deal between Iran and Saudi Arabia. Is that possible to even say those words 3 years ago? No, it's not. And so I think these are radical changes that are going on, and I think they go to the heart of the transition. They go to the heart of the transition. I want hydrogen production and ammonia storage in Rotterdam. I don't want your crude storage. Okay,
Yeah,
well, you're not going to get it then.
Yeah, I mean, OPEC and Saudi have been quite vocal recently about that. Yes, we're proceeding with transition investment, but for the next 10 years, we're openly saying we need to maximize our revenue from oil. And you would think they'd want the press there because they're trying to correct that story in the market about the shorts, etc., being quite vocal about it. But some press and some people at least were invited, maybe consultants rather than press, but I believe some invitations went out. So it'll be interesting to see what happens. Richard, just sticking with you about OPEC and what they might do this weekend in light of that question that we just put up, they will not cut. Do you agree or disagree? Can they really cut more at this stage? I mean, why would Saudi put itself out there to blend more support to the market itself? It's again a being sort of the supplier of last resort, if you like, the swing supplier provider. Russia, I think I addressed this earlier, but we're getting to the point now where that's probably one step too far for Saudi to take, isn't it? In terms of
Paul made a very good point. Demand is kind of what it is, and a PM one report from China is probably not enough to make a reaction to the market price. The article in the New York and the Wall Street Journal today, though, shows China, growth going from 6% to 2 to 3%. So maybe that's part of the story that they're saying, and I think. What from a trader's perspective, by setting the table that we're going to give you an ouch moment, you probably could cause a problem on the downside if you don't do something that is dramatic enough. I agree with Paul, though. There's not enough to go on yet. But maybe, the best trade is you don't do something and you wait another month and then you do it. You get all the longs out, you get the market down, and then you cut a bigger number. That to me would be a more impressive move. Remember, at the beginning of the year, they made their announcement. We were going to do nothing to the production level for the rest of the year, and they've changed it twice. What stops them from changing the third time? Right.
Yeah,
and I believe this transition is, to me, and maybe I'm going too far on this. I think this transition is starting to stick in their craw, and it's starting to get to them. And if I was them, I would try to maximize profit and do whatever I could to effectuate, get the longs out, get the shorts in, and then take it up.
Okay, Paul, let's just go to you for a little bit of perspective on other commodities. I'd like to just get your perspective on, metals, copper, etc. Those indicators for Asia specifically, what you're seeing there in terms of forward outlook and what that would tell us, obviously, about industrial activity, manufacturing. Give us a viewpoint on that, and particularly, you could address European demand as well, European and Asian forecasts for demand on that front.
I'm not the last person to talk on copper. I have far more.
Just the commodities in general, gold.
In short, certainly across base metals, it is very much determined at the moment by the flow of China data, and that has been disappointing. Obviously, base metals, particularly copper, are much more sensitive to China data than oil is, and China is. In most of those markets is 50% of global demand or more. So all of those have been trading fairly weakly, and most particularly copper, which has been the main way in which I think traders are playing a more of a negative stance on China. So a little bit of a disconnect, because oil is never quite that sensitive. Although we talk about China a lot, it's not moved entirely by China data. So that move we were talking about on the China PMI, that's more like a metals move, and that's metals will move on that sort of data to that degree. Oil not normally to that sort of a degree. So that I think that general concern that the more extreme views on how fast China was going to come back are not coming through. As our Standard Chartered's forecast is 5.8% GDP growth this year. We've been there virtually all year. It's so far it's coming out reasonably okay, and the strongest quarter would be Q2, but that's a base effect. We're looking for year-on-year growth for Q3 and Q4 in the kind of 5%, 5.5% sort of area. So metals very much driven by that kind of China view. So clearly, it's the kind of response you'd want it, expect. It takes time for the economy to recover. I think there was some overblown expectations at the start of the year to be just like that China would be back cow end of Q1, and there was talk of 1 million barrels a day of just additional jet fuel demand, which was never really going to come through, given how slow the return to international travel for China's going to be. So I think as expected, but perhaps confounding those more sort of extreme optimistic views right the way across the commodity complex.
Yeah, and of course, one of those extreme views was that we may see oil above $100 again. Certain banks were calling for that. Very quickly, Paul, do you think we'll go above 85 for the rest of the year?
Oh, at some point in the rest of the year, that's not a very difficult target. I mean, we're at 77 at the start of the week. So if we'd made the same move to the downside this week, and same route to the upside as we made to the downside, we already would have been at 85. So I think 85 is well within bounds. That's not a dramatic prediction. I think what's more out of bounds are those sort of 110s, 120s that would need some kind of major disturbance to I think take us out. But natural course of events, I think we do track up towards 85, again assuming that those fundamentals that really everybody's based on, the OPEC Secretariat, the IEA, the EIA, most of the banks, those need to sort of start coming through, and we see an extension of these inventory draws across the world.
Yeah, and of course we've seen adjusted forecast for demand as the year has gone on, and of course we'll get the evidence on inventories. Thanks so much, Paul. There's the result. 57% believe they won't cut. That's pretty close still. But let's see what they do next time we meet. We'll know. Thank you so much to Paul Horsnell for joining us today for the first time. Matt Stanley and Richard Razolia, thank you as always, and have a good weekend.
Thanks so much.
All the best.
Thanks, you guys.
Thank
Bye,
you.
everybody.